Did the Federal Reserve Chair give the green light for markets to keep rallying through the end of summer? Let us talk about it. Let us trade it. Tim Seymour, I get it. The hopes and dreams of a rate cut sparking buyers to come in. But is there any part of you that thinks the market maybe got a little ahead of itself?
Well, I think inflation is still an issue for the Fed. I'm not surprised we got a dovish comment today, and I do expect we will get a hawkish cut in September. I do think markets have shown that they want to see this posture in the Fed, and we've seen over the last month that retail, that home builders, that anything interest rate sensitive, certainly banks have rallied on that expectation. So this was affirmation. A drop of 15% in the VIX, again, something that's not necessarily dollar for dollar where you have to assume the market is going to go on the long run. But in the short run, I think that was an overreaction. I think to remove all of the other broader dynamics for markets is not the right thing to do. But again, weaker dollar, that's very supportive to international. It's very supportive to commodities. It's supportive to multinationals. I mean, there are trades here within the trade that worked today, and it wasn't mega cap tech. They worked, but they didn't work like the rest of the trades. And I think that's something the market should take a cue from.
I want to bring out the A word, Steve Grasso. Don't worry, the A word today is adjust. Because all right, because Jerome Powell said they were going to adjust rates. He didn't say they're going to cut rates. Now, he can't say that. I understand that. But he talked a lot about inflation. He talked a lot about tariffs. I read the speech, and I said easily, I could make a case for a rate hike.
Not a shot.
No.
He doesn't.
No, they're not. But I'm saying he kind of, it was really kind of an odd speech where he hedged both sides.
Yeah, he has been hedging both sides. He's been leaning on.
Well, then you're never wrong.
Yeah, but he's been leaning on the most important mandate to him at this time was inflation, stable pricing, not full employment. So he's already done that. But I think today he really had to give warning to the market that September they're going. You have the jobs number that was terrible. Then you have the PPI that shows inflation. I think for him, he had to really show that he was willing and able to cut rates, and that's what he's going to do. Now, is it 25 or is it 50? That's the question that we're going to have to make. But where's the neutral rate? Is it 3%, 3.5%? So that's going to dictate.
What does that mean?
How aggressive, where it's no longer inflationary or deflationary where the Fed sits. So that's your neutral rate. So we're at 4.3% basically, smack in the middle of the Fed funds rate. So are they going to cut down to 3.5? 375. How much are they really going to cut, and how aggressive do they want to be? I think the first cut, we'll get some of that.
Yeah, I mean, I think they're trying to determine what the neutral rate is. And like he's admitted, listen, we're mildly or modestly restrictive, I think he used. I mean, perhaps don't quote me on that. I think he acknowledged both sides of the risk. I think you're very spot on in terms of saying that he's been leaning more towards full employment. There's an argument on both sides. I do realize that most recent jobs number is certainly concerning. And I think essentially today was him acknowledging that. I think it would have been tough essentially for him to walk out there and kind of give us the same speech, not acknowledging, particularly if you're saying that you're data dependent. You've now had some glaring data that perhaps are showing you that there needs to be somewhat of a pivot. Where I think the market's got it wrong, Tim mentioned it in terms of the VIX. I think essentially it's not just this one cut. I think the market is essentially saying that we're now in an easing cycle. And I'm not sure if that's right. I think that's a bit premature there because, as you mentioned, PPI, we're still seeing some goods inflation. Now, services have kind of weighed against that to kind of balance things out. But there is still this kind of bubbling under the surface. And we will get to a point where they're forced to factor in both sides. Admittedly and probably right. I mean, I don't have a crystal ball, but it does seem that it was appropriate for him to give some credence to at least the labor market showing signs of deteriorating. That is somewhat preemptive. And until we see that is actually rolled over, and if they're doing their job and they're preventing that from actually being an issue, I think the likelihood and the necessity for future rate cuts should be called further into question.
Clearly, they're more concerned about jobs than inflation. Carter Worth, though, listen, coming into today, as we talked about on this show last night, there was I think it was a 74% chance of a rate cut, according to CME's FedWatch tool. It's now 87%. So it wasn't that big of a delta between the two. I mean, it wasn't like we were at 20% of a rate chance yesterday, and now we're at 87. 73 to 87 is not that big of a percentage change. Why was that enough to move the market almost 1,000 points on the Dow today?
That's the fickle nature of the thing. Think about this, Brian. In May, just as recently in May, there was 0 odds. And in fact, that higher for longer nonsense was getting to be sort of popular again.